Listen, what I'm about to show you is going to sound impossible, but the data doesn't lie. And right now, gold is setting up for the exact same move it made in 1980. Not similar, not kind of like it, the exact same pattern. And if you understand what happened back then, you'll understand why the next few months could change everything for anyone holding physical metal. January 1980, gold hit $850 an ounce. That's over $3,200 in today's dollars when you adjust for inflation. But here's what most people don't know about that spike. It wasn't gradual. It wasn't a slow climb. Gold went from $500 to $850 in less than 3 weeks, a 70% move in 21 days. Fortunes were made. Fortunes were lost. And the people who saw it coming positioned themselves accordingly. Now, I want you to look at what's happening right now. Gold just crossed $4,300 an ounce. That's a 67% gain in a single year, the biggest annual increase since 1979. Let that sink in. The biggest move since the year before the legendary 1980 spike. This isn't coincidence. This is history preparing to repeat itself. But to understand where we're going, you need to understand what caused 1980, because the same forces are lining up right now, and they're even more powerful this time. In 1979, inflation was running at 13%. The dollar was collapsing. Paul Volcker had just taken over the Federal Reserve, and nobody trusted the currency anymore. People were panic buying gold because they didn't know what else to do. Then came the geopolitical shocks, the Iranian hostage crisis, the Soviet invasion of Afghanistan. Suddenly, the world felt like it was coming apart. And when the world falls apart, people run to gold. That combination of monetary chaos and geopolitical crisis created the perfect storm. Gold became the only safe haven. And when everyone tries to get through the same door at once, prices explode. Now look at today. We've got inflation that's been running hot for years. The Fed printed more money in 2 years than in the previous century combined. The national debt just crossed $36 trillion. That's trillion with a T. The dollar's purchasing power has been systematically destroyed. And just like in 1979, people are starting to lose faith in the currency. But here's where it gets interesting. The geopolitical situation today is actually worse than 1980. We've got the Russia-Ukraine conflict, tensions with China over Taiwan. The Middle East is a powder keg. BRICS nations are actively working to replace the dollar in international trade. Saudi Arabia just ended the petrodollar agreement after 50 years. Think about that. The foundation of dollar dominance for half a century just got pulled out from under us. And central banks know this. That's why they're buying gold at a pace we've never seen before. In the past 2 years, central banks have purchased over 2,000 tons of gold. That's the highest level of buying in recorded history. China, Russia, India, Turkey, Poland, they're all loading up. And they're not doing it because they think gold might go up a little. They're doing it because they see what's coming. Here's something most people miss. In 1980, gold peaked and then crashed. It fell from $850 down to $300 over the next few years. And for decades, people used that as proof that gold was a bubble, that it was just speculation. But they're missing the critical detail. Gold crashed in 1980 because Paul Volcker raised interest rates to 20%. 20%. He literally broke the back of inflation by making the cost of money so high that the economy went into recession. That's what killed the gold rally. Can the Fed do that today? Can they raise rates to 20%? With $36 trillion in debt? With an economy that's already showing cracks? The interest payments alone would consume the entire federal budget. It's mathematically impossible. They're trapped. And that means when gold starts its next major leg up, there's no Volcker waiting in the wings to stop it. Let me show you what's happening in the physical market right now. The U.S. Mint can't keep up with demand for gold eagles. Premiums on physical gold are running 8–10% over spot price. That's the highest we've seen outside of the 2020 panic. Refineries are running at full capacity. Delivery times are stretching out. This is what happens when the paper market and the physical market start to diverge. See, most gold trading happens on paper, futures contracts, ETFs, derivatives. It's estimated that for every ounce of physical gold, there are 100 ounces of paper claims. That works fine as long as everyone's happy holding paper. But when people start demanding physical delivery, the whole system seizes up. And we're starting to see the early signs of that stress. The COMEX, the major gold futures exchange in New York, has seen its registered gold inventory drop by 40% in the past year. Registered gold is the metal that's actually available for delivery. When that number drops, it means people are taking delivery instead of rolling their contracts. That's a massive red flag. It means the smart money is moving from paper to physical. Now, let me paint you a picture of what happened to people who positioned themselves correctly before the 1980 spike. There was a coin dealer in California who saw the writing on the wall in 1978. He started accumulating gold coins when they were trading at $200. By January 1980, those same coins were worth $850. He turned $200,000 into $850,000 in less than 2 years. But more importantly, he preserved his purchasing power while everyone else watched their savings get destroyed by inflation. Compare that to the people who stayed in cash. If you had $100,000 in the bank in 1978, by 1982 it had the purchasing power of about $65,000. You lost 35% of your wealth just by sitting still. That's the hidden tax of inflation. It doesn't announce itself. It just quietly erodes everything you've worked for. And here's what keeps me up at night. The setup today is actually more extreme than 1980. Back then, the U.S. was still a creditor nation. We had manufacturing. We had a trade surplus. Today, we're the world's largest debtor. We import more than we export. Our economy runs on cheap credit and financial engineering. When the dollar loses its reserve status, and it will, the adjustment is going to be brutal. You're already seeing the early moves. Saudi Arabia is now accepting yuan for oil. China and Russia are settling trade in their own currencies. The BRICS nations are working on a gold-backed trade currency. Every one of these developments chips away at dollar demand, and when global dollar demand falls, all those dollars come flooding back home. That's when inflation really takes off. Think about the mechanics for a second. There are trillions of dollars sitting in foreign central banks and sovereign wealth funds. They're held as reserves because the dollar is the global reserve currency. But if the dollar loses that status, what happens to all those dollars? They get sold. They get converted into other assets. And what's the ultimate other asset? Gold. Now, I want to address something important here. If you're sitting on retirement savings, if you've got $100,000 or more in traditional accounts, you need to understand how gold IRAs work. I put together a complete guide on this. It's in the description below. It covers how you can move retirement funds into physical gold without triggering taxes or penalties, how the custodian system works, what the IRS rules are. It's worth looking at if you're thinking about protecting your retirement from what's coming. But let me get back to the main point. The technical setup on gold right now is absolutely screaming. We just broke out of a multi-year consolidation pattern. The 50-day moving average crossed above the 200-day moving average. That's called a golden cross, and it's one of the most bullish technical signals you can get. The last time we saw this pattern, gold ran from $1,200 to $2,000. And that was without the fundamental backdrop we have today. Look at the commitment of traders report. This is data from the CFTC that shows who's positioned on which side of the market. Commercial traders, the big banks and institutions, they're net long gold right now. That almost never happens. Usually they're short because they're hedging their physical positions. But when they go net long, it means they're expecting a major move higher. They're positioning for something big, and the mining stocks, they're starting to wake up. The gold miners index is up 45% in the past 6 months. But here's the thing. Mining stocks typically leverage gold moves by 2 to 3 times. If gold goes up 50%, miners go up 150%. We saw this in the 1970s. We saw it in the 2000s bull market. And we're starting to see it again now. The smart money is moving into the miners because they know what's coming. Let me tell you about the supply side because this is critical. Gold production peaked in 2018. We're not finding new deposits fast enough to replace what we're mining. It takes 10-15 years to bring a new gold mine online. And with environmental regulations getting tighter, it's getting harder and harder to permit new projects. Meanwhile, demand is exploding. You've got central banks buying. You've got retail investors buying. You've got industrial demand from electronics and technology. The supply-demand imbalance is getting worse every year. And here's something most people don't think about. A huge percentage of gold production comes from politically unstable regions: Russia, China, African nations. What happens if geopolitical tensions escalate and those supplies get cut off? What happens if China decides to stop exporting gold and keep it all for themselves? The price would go parabolic overnight. There's a concept in markets called reflexivity. It's when price movements create their own momentum. When gold starts going up, it attracts attention. That attention brings in new buyers. Those buyers push the price higher, which attracts more attention. It becomes a self-reinforcing cycle. And once that cycle starts, it's almost impossible to stop until it exhausts itself. We saw this in 1980. Once gold broke through $500, it was like a dam burst. Everyone who had been sitting on the sidelines suddenly wanted in. Coin shops had lines around the block. People were melting down their jewelry to sell it. The mania phase of a bull market is unlike anything else, and we're not even close to that yet. When your neighbor starts asking you about gold, when CNBC is running 24/7 gold coverage, when there are gold commercials during the Super Bowl, that's when you know we're in the mania phase. We're not there yet, which means there's still time. But here's what you need to understand about timing. Nobody can predict the exact day or week when gold makes its big move. What we can do is recognize when all the conditions are in place. And right now, every single condition that preceded the 1980 spike is present. Monetary instability, geopolitical chaos, central bank buying, supply constraints, technical breakouts. The only question is when, not if. And here's the thing about gold. It's not really about gold going up. It's about everything else going down. Gold doesn't change. An ounce of gold today is the same as an ounce of gold 100 years ago. What changes is the value of the currency you're measuring it in. When gold goes from $2,000 to $4,000, it's not that gold got more valuable. It's that the dollar got less valuable. Gold is just the measuring stick that reveals the truth. Think about it this way. In 1971, when Nixon closed the gold window, gold was $35 an ounce. Today, it's over $4,300. Did gold change? No. The dollar lost 99% of its value relative to gold. That's what 50 years of monetary expansion does. And we've done more monetary expansion in the past few years than in the previous 50 combined. What do you think that means for the next 5-10 years? I want to show you something that should terrify anyone holding dollars. The M2 money supply. That's the measure of all the dollars in circulation. Increased by 40% from 2020 to 2022. 40% in 2 years. That's not normal. That's not sustainable. And that money doesn't just disappear. It's out there in the system, slowly working its way into prices. We've seen it in housing. We've seen it in stocks. We've seen it in food and energy. And we're seeing it in gold. But gold is different from other assets. You can't print more gold. You can't create it out of thin air. You have to dig it out of the ground 1 ounce at a time. That's why it's been money for 5,000 years. That's why central banks hold it. That's why it survives every currency collapse, every empire's fall, every financial crisis. Because it's real. It's tangible. It's no one else's liability. Here's a question I want you to think about. If gold is just a barbarous relic, if it's just a pet rock with no real value, why are central banks buying it at record levels? Why is China accumulating thousands of tons? Why is Russia converting its dollar reserves into gold? These are sophisticated institutions with armies of analysts. They're not buying gold because they're sentimental. They're buying it because they know what's coming. And look at what happened in other countries that experience currency crises. Venezuela, Zimbabwe, Argentina, Turkey. In every case, the people who held gold preserved their wealth. The people who held the local currency got wiped out. This isn't theory. This is documented history. And the United States is not immune to the same forces that destroyed those currencies. We're just bigger, and it takes longer. But the math is the math. You can't run trillion-dollar deficits forever. You can't print unlimited money without consequences. The bond market is starting to figure this out. Treasury yields have been creeping higher despite the Fed's attempts to control them. That's the market saying it wants more compensation for the risk of holding dollars. When bond yields go up, it means bond prices are going down, and bonds are supposed to be the safe asset. If bonds aren't safe, where do you go? You go to gold. I've been studying markets for over 2 decades. I've seen bull markets and bear markets. I've seen bubbles inflate and pop. And I can tell you with absolute certainty that what we're seeing in gold right now is not a bubble. Bubbles happen when everyone's in. When your taxi driver is giving you stock tips. When people are mortgaging their houses to buy crypto. We're nowhere near that in gold. Most people still think gold is boring. Most financial advisors still recommend a 5% allocation at most. The mainstream hasn't caught on yet, and that's exactly when you want to be positioned. Let me tell you what I think happens next. I think we're in the early stages of a move that takes gold to $6,000, possibly $8,000 over the next 2 to 3 years. And I'm being conservative. If we get a real currency crisis, if the dollar loses reserve status faster than expected, we could see gold at $10,000 or higher. That sounds crazy until you remember that gold hit $850 in 1980 dollars, adjusted for real inflation, not the government's fake CPI numbers. That's over $15,000 in today's money. So $10,000 gold isn't extreme. It's actually conservative based on historical precedent. And here's what that means in practical terms. If you put $50,000 into gold today at $4,300 and it goes to $8,000, you've got $93,000. You've almost doubled your money. But more importantly, you've preserved your purchasing power while everyone else is watching their savings get destroyed by inflation. That's the real win. It's not about getting rich. It's about not getting poor. The window for positioning is closing, not because gold is going to crash, but because the easy gains happen in the early stages of a bull market. Once gold breaks $5,000, once it's on the front page of every newspaper, once everyone's talking about it, the risk-reward changes. You want to be early. You want to be positioned before the crowd figures it out. And look, I understand the hesitation. Gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. But that's actually its strength. It can't be debased. It can't be inflated away. It can't be hacked or frozen or confiscated easily. In a world where everything is digital, where your bank account is just numbers on a screen that can be changed with a keystroke, physical gold is the ultimate insurance policy. Think about what happened in Cyprus in 2013. The banks closed. People couldn't access their money. And when they finally reopened, the government confiscated a percentage of everyone's deposits to bail out the banks. It was called a bail-in. Your money, taken to save the financial system. That can't happen with gold in your possession. It's outside the system. It's yours, completely and totally. Or look at what's happening in Canada. The government froze bank accounts of people they disagreed with politically, just shut off their access to their own money. No trial, no due process, just gone. You think that can't happen here? You think we're immune to government overreach? Gold is the ultimate protection against that kind of tyranny, because it exists outside the banking system, outside government control. Now, I'm not saying sell everything and buy gold. I'm not saying go all in. What I'm saying is that if you don't have a meaningful allocation to physical gold right now, you're taking a massive risk. You're betting that the government will get its fiscal house in order, that the Fed will somehow engineer a soft landing, that the dollar will maintain its reserve status, that inflation will magically disappear. And maybe you're right. Maybe all of that happens. But what if you're wrong? The cost of being wrong is catastrophic. The cost of being right is you own some gold that maybe doesn't go up as much as you hoped. That's an asymmetric bet. The downside is limited. The upside is enormous. And in a world of uncertainty, that's exactly the kind of bet you want to make. Here's what I want you to do. Look at your portfolio. Look at your assets. Ask yourself honestly, what percentage is protected against currency debasement? What percentage is outside the financial system? What percentage would hold its value if the dollar lost 50% of its purchasing power? For most people, the answer is 0. Everything they own is denominated in dollars. Their savings, their retirement accounts, their home equity. It's all dollar-based, and that's a concentration risk that most people don't even realize they're taking. The 1980 gold spike changed lives. People who saw it coming and positioned themselves accordingly preserved their wealth through one of the most turbulent economic periods in American history. People who ignored it, who stayed in cash and bonds, watched their purchasing power evaporate. The same choice is in front of you right now. The same setup, the same opportunity, the same risk. And here's the final thing I want you to understand. This isn't about timing the perfect entry. This isn't about catching the exact bottom or selling the exact top. This is about recognizing a major structural shift in the global monetary system and positioning yourself accordingly. We're watching the end of the post-1971 dollar standard play out in real time. That's a once-in-a-lifetime event. And gold is the asset that benefits when monetary systems break down. The data is clear. The pattern is clear. The fundamentals are clear. Gold is setting up for the same kind of move it made in 1980. The only question is whether you're going to be positioned for it or whether you're going to watch it happen from the sidelines. Because make no mistake, this is happening. The forces are already in motion. The central banks are already buying. The technical breakout is already confirmed. The geopolitical chaos is already here. All the pieces are in place. What happened in 1980 wasn't a fluke. It wasn't random. It was the inevitable result of monetary and geopolitical chaos. And we've got more of both today than we had back then. The spike is coming. The only question is how high it goes and how fast it gets there. And whether you're going to be part of it or whether you're going to be one of the people asking yourself later why you didn't see it coming when all the signs were right there in front of you.